talk to us about setting financial goals for yourself. Rick has come to the library many times, and this will be our first time with Zoom. I'm sure it'll be really good.
Thanks, Maggie, and thanks for having me. And right off the bat, I want to wish everyone a very happy, healthy New Year. It's February. I know it's a little late to say Happy New Year, but Happy New Year just the same. Tonight, I want to talk about investing and setting financial goals because, as far as I'm concerned, there's nothing more important than setting your financial goals. Because if you don't set your financial goals, as far as I'm concerned, it's almost impossible to be successful. I always tell people that investing is a journey, and the first step on that journey, no matter what, is to find out your goals. I believe when it comes to investing, and I don't care if you have $1 million or $10 to invest, the first question you need to ask yourself is, why am I investing this money? Am I investing for my retirement? Am I investing for a down payment in a new home? Am I saving for a grandchild's college education? You have to know why you're investing. And it may be that you don't have a real goal other than to build wealth. And that's okay too. But you always want to focus on why am I investing money? Because the way you invest money is based upon your goals. That really dictates. A lot of people think that you invest based upon, what's hot. No, that's not what's going to make you a successful investor. And the other thing to keep in mind, there is a difference between investing and gambling. My philosophy is you should never gamble on Wall Street. They don't build those big, beautiful hotels in Vegas because people make money. They build it because people lose. When you gamble, the great majority of people are going to lose. On the other hand, when you invest your money, you expect to make money. It's a total different mindset. And so we want to talk about investing money to achieve your goals. And you have to know why you are investing. So the first question I ask investors is, what are you looking for from your money? And what goes hand in hand with that is to talk about the time frame you have to reach your goals. So if I said I'm saving for a down payment to a new home, you also have to know, when do I want to buy that new home? Is it a year from now? Is it 3 years from now? Is it 5 years from now? Different investments for different time frames. It's important that we understand that. If someone said to me, and they were 75 years old, and they said, I'm buying a house, I'm putting a down payment on a house at the end of this year. I have the money. What should I do with it to invest it for the year until I need it? I'm telling them, well, you should probably invest in a CD because the stock market is way too aggressive for a year. On the other hand, if I had someone who was 21 years of age and they said they had money they needed for a down payment for a house that they were going to buy at the end of the year, how would I invest their money? I'd invest it the same way as I would for the 75-year-old because their goals and their time frame is the same. That is what's important. Unfortunately, what many people do in our society, they invest based upon their age. And as far as I'm concerned, age is immaterial. Age says nothing about how you should invest your money. I get this all the time from people. They'll say, I'm 75 years old. How should I invest my money? I don't know. I don't know what the average 75-year-old, does. And then they'll say, yeah, but I'm 75 and I don't want to lose money. Fair enough. I don't know the 21-year-old who wants to lose money. It's not age that determines how you invest your money. it's your goals and objectives. And that's why setting those goals right off the bat is so important. Everyone has goals. You need to write them down, and so you can prioritize which ones are more important. Now, the second thing that goes along with this is understanding a little bit about risk. Everyone thinks the stock market is risky and CDs are conservative. The general belief is that with CDs, you can't lose money where you can lose money in the stock market. Well, to me, risk is a function of time. What is conservative for a year may not be conservative for 10 years. Example, that 21-year-old who's buying a house and has money for his down payment, I said it's a year away, we're putting it into a CD. On the other hand, if they were saving for retirement, and retirement is 50 years away, and even if they said they were a conservative investor, we're going heavily into the stock market. Why? Because over time, the stock market doesn't look very aggressive. It's aggressive if you look every day. It's the only investment you have that's valued every day. When you look at it, it's going up and down every day. However, if your goal is 10 years and 20 years and 30 years down the road, what happens day by day is immaterial. What happens 5 and 10 years down the road is much more material. So it's important to be a good investor. You understand risk. And let me tell you something. There is no investment, none, that anyone can tell me that is risk-free. It just does not exist. And I know there's someone out there on their computer and they're saying, wait a minute, Rick, I thought US Treasuries are risk-free. You can't lose money. And let me tell you this. If you buy a US Treasury, you're going to get your interest and you're going to get your money hands down. You don't have to worry about that. But that doesn't make it risk-free, because you know what risk you and I have to be concerned with? We have to be concerned with purchasing power risk. And anyone who is in their 60s or 70s, you understand what purchasing power risk is. Think about what $100 bought when you were a kid compared to what $100 buys today. In fact, if we were at the Troy Library, I'd ask people to raise their hands. How many people are driving a car more expensive than their first house? And people would be raising their hands. That's purchasing power risk. And the reality, we all know cost of living is going up. So if you're saving for something that's 10, 15, 20 years down the road, and you invest in a CD, that's very aggressive, because in no 10, 15-year period has CDs ever kept up with the increased cost of living and taxes. And yes, that includes the time back in the early 80s when we had interest rates of 15%. Yeah, you got 15% on a CD. The problem is cost of living was going up 16 or 17% a year. So you're actually losing money. So it's important as investors, we focus on what our goals are so that we know what to invest in. And when we invest, we have to recognize every investment has risk. Stock market goes up and down, yes. CDs stay the same, they don't fluctuate in value, yes. However, if we're talking long term, CDs don't keep up with the increased cost of living. And that's what we need to do as investors, because we need a rising income. We need to make sure that we're keeping up. So don't focus on the investment itself and say CDs are conservative, stocks are aggressive. It's the wrong way to look at it. What you have to look at is for my goals, what's conservative, what's aggressive. If someone said to me they're saving for retirement 20 years down the road, the conservative move is stocks because they've always performed. They've never been a 20-year period where stocks have lost money. The aggressive position is to go into CDs because what you're hoping for is that for the first time in history, CDs will make money. So that's why it's so important to set your goals so you know how to invest. Now, when it comes to investing, I always tell people it's like planning a vacation. So when you plan a vacation, you usually decide where you want to go, what you want to do, and how long you're going for. And then you pack. That's exactly what we should do with our portfolios and our investments. We need to decide where we're going and how long we have to get there. Because if you pack first and then you realize, and then you go on your vacation, you may open up that suitcase and you have the wrong clothes. So think about this. Troy Library is going to give everyone a free vacation. And so you're going to have to go home and pack, and we're going to give everyone gets a free all expense paid vacation. There's no gimmicks to it. Well, what would you want to know? Well, you first would want to know where we're going. Why would you want to know where we're going? So you know how to pack. Because the question is, are shorts good or bad? It's where I'm going. If we were going to Florida this time of year, shorts would be great. On the other hand, if we're going to Alaska, I'm not so sure shorts would fit the bill. So the issue isn't whether shorts are good or bad for vacations, it's where you're going. And that's why it's so important. You know where investors make mistakes? Investors make mistakes because they ask the question, should I buy Apple? Should I buy GameStop? Should I buy this stock or that stock? That is the wrong question, because that's like asking, should I take shorts on my vacation? Unless you know where you're going, how do you make that determination? And it's the same thing with investing. What you need to let dictate your investment decisions, you need to let your goals and objectives and the risk tolerance you're willing to take. That's what dictates. So when someone says they're conservative, that doesn't mean they avoid the stock market. Far from it. They may have a significant portion of their money in the stock market because their goals are long term. So to be a good investor, don't focus on your investments. Did he really just say that? Yes, I did. Because what's more important for you is to make sure you have the right allocation. The right allocation is determined by your goals and objectives and your risk tolerance. So, as an example, when I manage someone's portfolio, I build out the proverbial pie chart. 10% in this, 20% in that. I build that out before I look for any investment, because I'm not letting the investment dictate what I'm doing. I'm letting the goals and objectives dictate. So the question isn't, should I buy Apple? The question is what should I buy to achieve my financial goals? And that's what you have to look at to be successful. So many people get caught up in the hype of the market, buy or sell, when the focus should be on those allocations and not trying to time the market. And let me tell you this about timing the market. It can't be done. No one has done it successfully ever. So what makes people think they can do it now? Good news is bad news is good news. Let's, as an example, look what just happened over the last few months. there was a general consensus that if the election, if President Biden, who won the election, the stock market would have a dramatic tumble. So when Biden won, people sold their investments out. Well, that didn't happen. The market has gone up, which means people that tried to time the market were wrong. When you try to time the market, you have to be right twice. Once when you buy and once when you sell. And I don't know anyone that could do that successfully. So why try? But you know what we can time? And you know what we do know? We know our goals and objectives, and that's what we focus on. So if you're saving for retirement and retirement's 20 years down the road, it's one thing. You're saving for retirement, retirement's 2 years down the road, it's another thing. You manage based upon your goals and objectives, not what's happening in the stock market day to day. Let me tell you this. I've dealt with the stock market for more years than I want to think. It is irrational over the short run. It doesn't make sense. It makes sense over the long run, but anything can happen over the short run. That's why I always tell people, if your goals are short term, you don't belong in the market. It's more gambling. Now, if you want to gamble, that's fine. But I wouldn't gamble with my retirement money, and I would always remind myself that more likely than that, I'm going to lose when I gamble. So you have your goals and objectives, and that really is the key to everything. And you look at what sort of risks you want to take. You know, if you're a long-term investor and you're a conservative investor, that may mean you have more money in large company US stocks. You're more aggressive, you may have a little more money in emerging markets and new economies around the world. But you still, no matter where you are, conservative, aggressive, you need investments in a variety of different areas. You need diversification. You need to spread risk out. When you don't spread risk out, you're taking a gamble. And again, when you gamble, more likely than not, you're going to lose. Now, what I believe when it comes to investing, you have to set some rules for yourself, because there are so many minefields when it comes to investing. You have to have a way of protecting yourself. So I want to run through the rules that I live by that has allowed me to protect myself and my clients. So one, I never invest in anything that I can't check out independently. I don't care what they say on CNBC. I don't care what I read on the internet. I want to check things out independently. If I can't find independent information on an investment, I'm walking away from it. Even if it sounds like the greatest thing since sliced bread. If I can't check it out independently, I'm not investing in it. Now, would I ever take a gamble? Sure, I would take a flyer on something that I checked out. However, it's not the same thing as an investment. When I invest in something, I expect to make money, and I want to check it out independently. And in today's world, there's so many resources that you can use to check out an investment independently. The library has great resources. Two, I don't invest in anything that doesn't have a track record. Now, that means I'm willing to give up something on the high end, not to get hit on the low end. I want to see investments that have done well over time. Everyone thinks, oh, a new thing is going to happen and it'll make things so much easier and it's the greatest thing since sliced bread. Well, it just doesn't work that way. So I want to see investments that have had track records, and I want to look at their track records. Generally, what I'm looking at is 3, 5, and 10 years. I know what some people are going to say. I get this from different mutual fund companies all the time. Well, we don't have, a 10-year track record yet, so it's not fair that you hold us to that standard. Well, my answer is, what do I care if I'm fair or not? I'm dealing with people. You don't have to be fair. This is your money. So you need to set rules. I want to look at track records because I want to see someone who's done well at different points in time. Anyone can have a good year, anyone can have a bad year. Start looking at track records, you're going to have a better trend. 3, I never invest in anything that I don't understand. I always like to tell people I'm not the smartest guy in the world. I hope I'm not the dumbest. If I don't understand an investment, I'm walking away from it. I see people that invest in things that like limited partnership, hedge funds. And when you ask them, do they really understand it? And they go, well, no, but other people are investing in it. Well, my dad used to tell me if everyone's jumping off the bridge, you don't want to jump off the bridge as well. You have to be able to understand an investment. When I say understand it, you should know how you can make money, how you can lose money, and how you can get your money out when you want. If you don't know those 3 things about an investment, you ought to walk away from it. We get a lot of people these days that are buying annuities. And I always ask people that buy annuities if they ever read those contracts. And I've never met anyone who's read them. And anyone who's attempted to, they say they're just too complex to understand. I say, what does that mean? If it's too complex for you to understand, you ought to walk away from it. Because they can write it in simple English if they wanted to. But I figure the more confusing it is, it's bad for me, the investor. So I have this rule: if I don't understand an investment, I'm walking away from it. I'm not going to let people bully me. I'm not going to let people pressure me. I believe in the old adage, keep it simple, stupid. That's what I say to myself all the time. Some of the worst mistakes investors make is they get into things they don't understand. We ran into this particularly in the financial crisis where people invested in hedge funds and then they found out they couldn't get their money out when they wanted to. We see this a lot with annuities, especially variable annuities, where people lock up for 10, 15 years, and to get their money out, they have to pay these huge penalties. Understand investment before you get involved in it. 4, my friends like to call me cheap. And it's true. I am a little tight with a buck. I, believe that I work hard for my money. I want to know what I'm spending. I don't invest in anything that I don't understand what it costs me. What it costs me to buy, what it costs me to sell, what it costs me to hold. You need to do the same thing. And one thing you find, the higher the cost investment, the less return that ends up in your pocket. Costs do matter. Now, all the investments I always recommend are commission free. And my philosophy is money looks better in your pocket than it does anywhere else. And I think you should be cheap about your investments as well. You need to look at the cost of them. And you should know and ask questions. In some of these annuities, they tell you that, well, you have no cost. You don't pay anything. Well, does that even sound reasonable? Someone's paying the salesperson, but they don't want to tell you about the penalties. You have to find those things out. Check the investment out independently. Look at the cost. High costs equal low returns, period. Lastly, my last rule is, we have to be reasonable when it comes to investing our money. I wish I could tell you an investment that will double your money in 2 weeks. I can't, and neither can anyone else. So when you hear people make these outrageous claims, you need to walk away because it's not true. I always want to believe that you could take a pill, never exercise, and lose all the weight you want. I pray that that's true, but I know it's not. It's the same thing with investing. You can't double your money overnight. And anyone that tells you these things, you have to walk away from. You have to be reasonable. And I believe by following these 5 rules, you're going to protect yourself. Does that mean that, every investment it's going to be the best investment? No. You still can lose money, but you're eliminating the risk that you're going to be taken advantage of. Because good investments sometimes lose money as well. Now, as we set our goals, there's one goal that everyone has or everyone should have, and that's dealing with retirement. As I always like to tell people, retirement is a brand new concept in the history of mankind. This isn't something that past generations had to worry about. I mean, think about it. Go back 100 years ago. What do you think people did? They went home on Friday and they died. Well, fast forward to today, when we plan for someone's retirement, we're not planning for 2 years, 3 years. We're planning for 20 and 30 years. And think about the younger people today, someone in their 20s, when they retire, it's not going to be a 30-year retirement. It's going to be a 40 or 50-year retirement. And so I remember when I first got involved in this business and they talked about retirement, what they would tell people is look at, you're going to have 5 good years in retirement at most. After that, you're going to be old and there's nothing you could do. So get people through the first 5 years. You retire at 65 and at 70, it's over. Well, look at the world today. That's not the way it is. We look at someone who's 65 and retiring as round 2. They're not getting ready to check out. They're getting ready to enjoy their life. You can't, well, no one can go on a cruise today, but when they have cruises, half the cruise ship is over 65 or 70 years of age. You have people today that are doing all sorts of wonderful things in retirement, whether it's traveling around the world or all sorts of things. And so you have to look at that and say it's a new concept when it comes to retirement. The other thing is, when they used to teach us, they used to tell people when you retire, you could live on 2/3 of what you did when you were working. And that was based upon the fact that you're in your 60s, you're old, you're not going to do anything. Well, that's not true today. Today, I tell people you have to have a rising income throughout your lifetime. You can't live on a fixed income. You have to live on a rising income. When you retire at 65, when you're 75 and 80, it's going to cost you a lot more to live. And so that is why retirement is a whole new concept in the history of mankind, and we have to think about it differently. And so I think, and I always tell people this, the day you start working is the day you start saving for your retirement. So if you're 21 years old and you're starting your career, this is when you should start saving for your retirement. You have to start as soon as you can because the numbers are startling how much you are going to need. Think about someone who even retires today, and we say they're going to live for 30 years. Think about how expensive it's going to be 20 and 30 years from now to live. That's why you have to start saving for your retirement early. And everyone, I don't care where you are in life, needs to be concerned about retirement. Now, typically, as you get closer to retirement, and I tell people when they're in their 50s, it's a good time to start figuring out what your retirement number is. And what that number is the number you're going to have of assets in order to maintain your retirement. So what I generally tell people to do is to first start with where their money is going, what it costs them to live a month. And what a lot of people do is they say, well, they write some numbers down and they say, this is it. and it's almost always wrong. It's almost always under the right number. So I tell people is to focus on what comes into the family every month. And then figure out what you're saving. So if you're bringing $5,000 a month into the family and you're saving nothing, your cost of living is probably $5,000 a month. It is an important number to know. It is the key to retirement savings, is to know what it costs you to live a month and be fair with yourself. If you're used to, you play golf, that's a cost. You buy grandkids presents, that's a cost of living too. You want to know what it costs you to live a month. So if we use a number and we say it costs you $5,000 a month to live. So from that, we want to subtract what your pension and what your Social Security will be in retirement. So most people, let's say in their 50s, are not going to have pension. So let's just say for round purposes, it costs them they're going to get $3,000 a month in Social Security. So take what their cost of living is, subtract the Social Security. We have a $2,000 a month shortfall. We want to annualize that. So that's $24,000. And then what we want to say is we're going to need 25 to 30 times that number. That is the number that we're going to need in order that we can cover that shortfall. And it's a big number, and I know it, and it's an intimidating number. However, it's important that you know that number because that's one of your goals. I have this all the time where I sit down with people and they've never looked at their number and they're 70 years old and they want to retire, and you have to tell them they can't afford to because they didn't save enough, their cost of living is too high. Well, you don't want to be in for one of those shocks. So you want to know what it costs you to live so you can focus on that number, because that's going to be a key number to have. So as you get closer to retirement, that number becomes even more important. But one of the mistakes people make is they think that once they retire, they never have to relook at their number, and that's not true. You do have to look at your number. And in fact, when you're retired, that number is just as important. Every year you need to relook at it. And why do I say that? Because you need to know what it costs you to live at all times. So if all of a sudden, your number is, your shortfall is greater, well, then you may have to cut back on expenses. Well, you want to be in a position to be able to cut back on expenses when you have time to do it, as opposed to all of a sudden creeping up on you and you have no options. So I generally recommend that when someone's retired, every year they recompute their number and to see where they have, if they're over their safety number or they're below it. Below it, you have to look at ways of cutting your expenses and becoming more efficient with your money. If you're above the number, yeah, you have a little more cushion. And that's how someone, manages their way to make sure they can stay retired. Because one of the problems we have in our society, we have people that retire at 65, and then by 75, they're the greeter at Myers because they've ran out of money. They've run out of money because they really never focused on what their number is and to assure themselves they have a rising income by investing in a growth portfolio. So I cannot stress enough how important it is for people to start saving for retirement as soon as you can, but also to maintain your finances throughout retirement. Constantly look at your goals and objectives and make adjustments based upon that. Now, before we open up for questions, I do want to talk about what's been happening in the stock market the last few weeks with GameStop. Many of you heard this story that the stock, it was up over 1,000%. And everyone said, oh, I should have jumped into it. I should have jumped into it. Well, you shouldn't have jumped into it. It was a pure gamble. Some people are going to make money and some people will lose money. But there's a lesson to learn from investors. And the lesson to learn of this is just don't jump on the bandwagon. Because there are a lot of people that are going to lose a substantial amount of their portfolio. And the reason is they got caught up in the frenzy of buying this stock. So they bought this stock at $300-400 a share. In reality, the stock is worth less than $100 a share. So when the market adjusts, which it eventually will, people are going to lose. So if you want to know what happened, so GameStop was a stock that many hedge funds were shorting. Now, when a hedge fund shorts a stock, what that means is they are borrowing, they don't own the stock, they're borrowing the stock, they're selling it now with the contract obligation that they have to replace that stock sometime in the not too distant future. So what the hedge funds are looking at, they're saying the stock's selling for $20 a share. So we're going to borrow shares and sell them. And we're hoping that the stock price will go down to, let's say, $5 a share. So that's when they'll buy the shares to refund them. So they sold when it was 20, they're buying when it's 5. That's how you make money. However, people on this Reddit chat room wanted to punish the hedge funds for the way they do business. And they got millions of people through their chat room to buy GameStop stock. So when you have more buyers than sellers, the stock price goes up. And that's exactly what happened. The stock price kept rising. And then what happened? The hedge funds got nervous and they had to turn around and buy the stock themselves. More people buying the stock shot up. And that's why the stock rose. Well, eventually what happened is some people start taking their profits and realizing this ain't a $300 stock, and the stock has started to fall. And that's where the people in it now are going to lose money because they're the average shareholder. They're the average individual, and they got caught up in this frenzy. That's not the way investors should invest in the stock market. We invest based upon our goals and objectives. We don't worry about where the market is on a day-to-day basis. What these people did was not investing, it was gambling. And just like they're going to lose their money when it comes to gambling in Vegas, they're going to lose their money when it comes to the stock market. So this is not something you should be doing. And in fact, I think for the great majority of people, you shouldn't even be investing in individual stocks. It's sometimes too difficult to know what a company is. What you should be doing, I prefer generally things like mutual funds. They're not as sexy as an individual stock. You certainly can't make as much if the stock goes up as you can if you had the individual stock. But over the long run, it's going to be easier for you to achieve your financial goals, and it allows you to have more of a balanced and diversified portfolio. So I think for the great majority of people, you ought to avoid buying individual stocks. They're too difficult to figure out. You don't know what's up with the company half the time. It's better buying mutual funds. And when you buy mutual funds, recognize that not all mutual funds are the same. There's a lot of differences. And again, you have to do your research, but there are a lot of tools out there and you can be much more successful. So when it comes to investing, don't focus on the sexiness that you can make 1,000% of your money in 2 weeks. No, focus on the long run. Focus on building a portfolio that's based upon your goals and objectives and diversified and stay within your risk tolerance level. and you're going to be successful as an investor. When you try to gamble, you can hit something right once, but more likely than not, over the long run, you're going to be a loser. So on that note, Maggie, what I want to do is to open it up for questions that people have.
Hi, go ahead and put any questions in the Q&A, which is down at the bottom of the screen. Any questions that you have, and I'll read them to Rick today.
And while people are in the questions, I do want to remind people I now have a podcast, Rick Bloom Talks Money, and I'm recording my next episode on Thursday, and it's going to be about the GameStop situation, from what investors need to learn from it, because they got more publicity than just about any stock movement I've seen in a long time.
Rick, what were some of your other podcasts that you've done in the past?
Well, I've done some on scams that people need to be aware of that are affecting us in Southeast Michigan. Talked about some of the basics of investing, talked about stock market, bond market. So we've had a whole variety of ones. We also did one on estate planning. And the thing about the podcast, I try to make them in English so people understand it, and make it simple to understand. I think that's the key.
Okay. Anyone have any questions? I'm sure somebody's got some questions out there. Oh, Rick, can you tell us about your company name change?
Sure. So we used to be Bloom Asset Management. We're now Bloom Advisors. And the reason for that, when we looked at our business and we realized what we do, asset management sounded something like in the 80s. And in reality, our business has changed over the years. We do much more in advising people, helping them make decisions, that affect their money, whether they should refinance their house, whether they should buy whether they can afford to buy a second place in Florida. So we looked at it and we said, that's really what the core of our business is to advise people on their money so they can make the right decision. So yes, we still manage people's portfolios, but we actually answer more questions for our clients than anything. Can they afford to retire? So we felt that it better reflects who we are as a firm.
And I have a question. What's the name of your website?
It's bloomadvisors.com.
I'll put that in there.
Yeah, very simple. And, we're trying to make the website educational. That's one of my goals with the podcast is I do want to make it educational. And I always tell people on it, there's no geek speak on the podcast. We're talking simple everyday English. And we're going to talk about topics that people can relate to their situation. As an example, I did a podcast because people asked me about what my thoughts of like Dave Ramsey are, and so we talked about that. I said certain things I agree with, certain things I disagree with him.
And then when does it make sense to hire a professional to manage your money?
Well, I think there's a couple things that you look at. One, you have to be honest with yourself. If you're paralyzed by analysis, that you end up like the hamster in the wheel, you're running real fast, but you're going nowhere, that's an indication that you need an advisor. If you've been sitting on a lot of cash, waiting for the right time to invest, in fact, there's a lot of people that still haven't reinvested since the financial crisis in 08 and 09. That's when you need a financial advisor. I'd also tell you another time you need one, and that's a reward to yourself. That sometimes you reach a point where you don't want to watch it. It's getting too complex and things are not as easy as they used to. So that's your reward to yourself, that you can hire someone to manage your money that is going to hopefully do a better job than you do, but take that burden away from you. It's sort of like sometimes Can I shovel my own snow? Yeah. But sometimes I want to reward myself by hiring a professional. And you should know there are different types of financial advisors. Um, One of the things that distinguishes us is that we work for our clients in the fact that we never take commissions and we never take any hidden fees. All our fees are upfront. We get them from our clients. So we get paid nothing from any investment, from anything we put our client in. Our fees totally come from our clients. We're not what is known as a fiduciary. By law, we have to operate for our client's best interest. And that's the way we want to do it as a firm. So if I recommend someone do this or do that, there's no financial interest for us whatsoever. We purely look at what's good for our clients.
Okay, someone says, I've read recently that some financial planners are now suggesting dropping to a more conservative stock allocation, 30% in the first year of retirement and gradually increasing that to 60% over 15 years. What are your thoughts?
I don't like that because I want to base things upon the individual. So I believe, I don't know what a typical 65-year-old, typical 70-year-old is anymore. So I think when they come up with some of these rules to apply to everyone, it just doesn't make sense. For some people, that strategy may work, but others it doesn't. And I'll give you an example. I have a client in his 90s, and all his money's invested long term, and he's not really an optimist. Now, the reason why his money's invested long term, because his goal is to pay for all his grandkids' college education. And he's got young grandkids. So that's all long-term money. So I don't like using age because it doesn't say what's important, and that is achieving someone's financial goals and objectives. In today's world, you have a lot of that where grandparents want to help their grandkids through college and things of that nature. So the strategy you want to follow is what's going to achieve that goal. I just don't like using age because age just doesn't say a lot about people anymore. There are 75-year-olds who are working. There's 75-year-olds who are retired. There's 75-year-olds that have all the money they need. There's 75-year-olds that have to borrow from their kids. So you don't want to be thrown in a mix. You want to do things based on your individual situation. And that's what we always try to do at our firm. Look at you as an individual.
Okay, I had a couple questions. Somebody, mentioned that index funds best to own. And then somebody asked, maybe I missed it in this presentation, but could you talk about index funds and who they're good for? And then somebody else then talks about managing funds versus index funds.
Okay, so let me explain what an index fund is. And I generally like index funds. You can have an S&P 500 index fund. And what that fund does, it invests in all the stocks in the S&P 500 according to their allocation. So if it's a Russell 2000, there's all sorts of different indexes. So those funds don't have active management. They buy the index. So I think for especially large companies like the S&P 500 fund, I got no problem buying indexes. And I think they work out well, could really cut the cost of your investing way down. On the other hand, for other areas like small company US or emerging markets, I'm not so sure that index funds are so good for that. So I think that for larger companies, whether larger international, larger US, index funds are fine. But I question them for smaller companies. I also think that you shouldn't have 100% of your portfolio in index funds. And the reason I say that is because that can be a little too aggressive. Index funds are always 100% invested. They're always fully invested. So if the market is tanking, they have no choice but to stay in the market. Managed funds have flexibility. So I generally like having a mix of index funds and actively managed funds. And I know what the general consumption is that there's a lot of active management funds that don't do as well as the index, and that is true. But the index is more aggressive. So because it's 100% invested. So typically, someone who's a little more on the conservative side, I probably want to have a little more actively managed funds because the portfolio managers can bail out into cash where an index fund can't. So that's the way I look at it from that standpoint.
Okay, I have another question. Is it okay to take input for investing from a company like Jeff Brown Research?
I'm not familiar with Jeff Brown Research. So I don't know what that company is. Now, I think it's okay to take research from places like Morningstar. So I see no problem getting research from, certain companies. But I'd be cautious depending upon what you're really paying for. You got to be careful because there are a lot of less than ethical people that sometimes sell research. But I got no problems. But I would also tell you that a lot of times through Fidelity or Schwab or Vanguard, you can get a lot of information for free on those websites, a lot of really good information.
Okay. Any other questions? Do you have anything else to add, Rick?
Well, let me just add a couple things. First of all, over the next few weeks, you're going to start getting your information for taxes, whether 1099s or W-2s. And I can't tell you how important it is to make sure you save those documents. It is extremely important. I think the number one goal most of us have when we file our tax returns is we don't want the IRS calling. And to do that, you have to make sure your returns are fair and accurate. And to do that, those 1099s and W-2s are important. So whatever information you get over the next few weeks, you should save it. Now, there's also something that if you're decent with a computer, you don't necessarily have to pay someone to do your tax return. The IRS has a program, it's called Free File. If you go to the IRS's website, irs.gov, click on Free File. It allows someone to use the software of companies like TurboTax and TaxSlayer for free, and then to file your federal return for free. The one requirement is your adjusted gross income has to be less than $72,000, which about 70% of Americans qualify. So you can go online and you can do your tax return for free. And I always say, if you could save a few $100s in cost of doing your tax return, why not? But to take advantage of it, you must link through the IRS's website at irs.gov. And I know what a lot of you are thinking. Wait a minute, it's the IRS. They're not going to be fair to us. I'm telling you, they are fair. This program has been around for years. And it's not the IRS that's computing your return. It's TurboTax or TaxSlayer or whatever software you choose. It is free, and it's something more and more people should take advantage of. And so I would recommend that people would do that. I also think this is the time of year that, New Year's, we making New Year's resolutions, or most of us is probably broke all our New Year's resolutions for now. But one thing people should do this time of year, I think it's a good time to shop around your homeowners and automobile insurance. Get competitive bids. You'd be surprised how much you can save by being competitive. And I don't believe the insurance companies love us, and certainly we don't love them. So you should have no problem shopping around and getting competitive bids for your homeowners and automobile insurance. And, sometimes when you group them together, you get some additional discounts. And I would tell you, you should always ask what discounts are available. You'd be surprised with homeowners and automobile coverages that you can get all sorts of discounts, and you should take advantage of it. Also, you should look at your life insurance coverage. You see a lot of people that have life insurance policies they don't need. Why keep paying on them? My philosophy is look at, we're all going to die. We all know that, but not everyone needs life insurance. Life insurance is not an investment. I never think it's a good investment that I have to die to collect on something. All insurance is a means of covering risk. Now, I don't have boat insurance. The reason I don't have boat insurance because I don't own a boat. I don't have golf ball insurance. Not that I'm not going to lose golf balls when I play because I do all the time. However, I can afford the buck a ball that it costs me. So I don't need to insure. We insure what we cannot afford to lose financially. And so a lot of people have more life insurance than they need, or they have policies they just don't need. It's not a bad idea to do something different with that money. And lastly, let me just add from an estate planning standpoint, great time of year to go through your estate plan to see if it needs updating. If you haven't done one, you need to make sure you do one. Every adult in Michigan, I don't care how rich or how poor you are, you need some sort of an estate plan. It could be a simple will with a medical power of attorney. You can get those forms for free. You can get them on our website. But one thing people should do is one, check their beneficiaries. Primary and secondary beneficiaries on 401k plans, insurance policies. Wherever you have a beneficiary, you should check it out. I cannot tell you how many times I've had to deal with a situation where an ex-spouse that had been divorced for 10 years is named as a beneficiary, and that causes all sorts of problems. And lastly, what everyone should do what I call a document locator. God forbid something happens to one of us. How easy would it be for our loved ones to know where our assets are? Would they know what our online presence are? And we need to make it easy for them to find that out. So you should have a document that something happens to you, someone knows where to go so they know you can see what you have. They don't have to know what's in your Fidelity account, but they have to know you have a Fidelity account and what's your ID number, what's your user ID, and maybe what your password is. There was a story, I don't know if you saw this, Maggie, that a guy had 250 million, that's million with an M, dollars of Bitcoins. And he lost his password. And because he lost his password, the money is gone. He can't get it. Now, most of us don't have $250 million we're going to lose, but we don't want to lose anything for our loved ones. And so if you want to make sure that everything goes to you want it to, make sure it's easy for people to find. You need to do this document locator. You need to update it all the time because as passwords change, user IDs change, accounts change, you may need to make a change. But you do it, and remember this, the reason why you do estate planning, it's really not for you. You do it because you love your loved ones. You want to make sure when there's a family emergency or death that life goes on. And having a document organizer so people know where things are, where your will is, what your accounts are, where your passwords are, it'll make things a lot easier. So I just wanted to add that, Maggie.
Okay, I have another question from a viewer, but before I do that, I want to mention to the people here that if you have a Troy Library card, we also have Morningstar and Value Line on our website that you can have access to. So that's just something to know about. The last question is, I have some questions as proper tax returns for grad students getting paid via fellowship. Can you suggest a company or website that could turn to for questions? So this person must be a grad student getting paid via a fellowship.
Yeah, and there's different types of fellowships. I'll tell you where I would go. I know this will sound strange. I'd go to the IRS's website. The IRS website has a lot of good information. And what happens on these fellowships, it's going to be dependent upon how the university is treating it, what they're issuing you. Is it, if they're issuing you a W-2, it's taxed. And it's going to be taxed to you. But there are certain 1099s they can issue that are not taxed. So I would get the information from the IRS's website. If you can't find it on the IRS's website, if you drop me a line, I will get the information for you. If you send me an email, rick@bloomadvisors.com. If you can't get it from the IRS, let me know and we'll get you the answer.
Okay. All right. Are there any other questions for Rick? All right. Well, thanks, Rick. We really appreciate it. And thank you all for coming.